Hello and welcome to Part 8 of our Compliance Briefs series on client due diligence. This is the final part of the series, and our focus today is on transaction monitoring, a crucial defense against money laundering and terrorist financing. In this session, we will cover a number of important areas. We will begin with what the AML law says, followed by the requirements of the ICPAC AML and Sanctions Directive. Then, we'll explain why transaction monitoring is so important and what firms need to consider when designing their systems. We will also discuss the key questions every ICPAC member should ask and take a closer look at risks linked to charities, foundations, and other non-profit organizations. From there, we'll move on to the differences between auditors and administrative service providers, the role of accountants in transaction monitoring, before looking at the transaction review process, spot checks and cold reviews, and finally, the rules for keeping transaction records. Let's start with what the AML law actually requires. Article 58A tells us that transaction monitoring is part of the overall risk assessment process. Put simply, when we assess a client, we also need to consider how their transactions could expose us to risk. Article 61 goes further by requiring that client due diligence includes ongoing monitoring of the business relationship. This entails scrutinizing transactions carried out throughout the course of the relationship, ensuring they are consistent with the information and data held by the obliged entity regarding the customer's business and risk profile, and where necessary, the source of funds. Additionally, it requires that all documents, data, and information held are kept accurate and up to date. Article 63 allows for simplified measures, but only when the risks are low and there are no suspicions of money laundering or terrorist financing. By contrast, Article 64 requires enhanced measures when the risks are higher. In other words, the higher the risk, the stronger the monitoring needs to be. After looking at what the AML law requires, let's now turn to the ICPAC AML Directive, which gives us more practical guidance. According to paragraph 5.9, firms must carry out detailed examinations of transactions that may be vulnerable to money laundering or terrorist financing. This applies especially to complex or unusually large transactions, and to unusual patterns that don't seem to have any clear business or lawful purpose. When setting up monitoring procedures, firms need to take into account the type of services they provide, the client's risk level and activities, and clear parameters that help spot vulnerable transactions. In simple terms, the directive emphasizes that we can't just look at the size of a transaction, we need to ask whether it makes sense for that client's business and profile. The ICPAC Sanctions Directive provides specific guidance on the importance of screening customers and transactions, as well as the measures members are required to take. Section 4 of the directive is fully dedicated to this process. When processing or reviewing a transaction, it is important to identify all parties involved, including the client, directors, and counterparties in agreements. A written record of the screening should always be maintained. Section 4.8 explains that transaction screening means reviewing the movement of value within the firm's records, whether funds, goods, or assets, between parties or accounts, in order to identify potential sanction targets. Screening must take place in real time before the transaction is executed. The focus should be on cross-border transactions, which carry higher risk, while domestic transactions are generally subject to the same jurisdictional rules. Section 4.9 reminds firms to remain alert to sectoral sanctions. Screening processes must be tailored to cover these as well, since they can restrict a wide range of markets, products, and services. Even if we perform very thorough client due diligence, that alone isn't enough to fully manage risk. Firms need strong systems and controls in place to continuously monitor client transactions. This is not a one-time exercise, it's ongoing and constant. That's why transaction monitoring is such a key part of AML, CFT, and sanctions compliance. It acts as one of the strongest defenses against clients who may try to misuse professional services to hide illegal activity. Let's now look at some steps that firms can adopt to build an effective transaction monitoring process. Step 1 is about knowing your client. This means understanding their beneficial owners, their counterparties, their background, their business activities, the industry they operate in, and even their typical spending and investment behavior. With this knowledge, the firm can build an expected transaction profile and use it to spot unusual activity. Step 2 is about risk assessment and resource allocation. A firm's monitoring system should reflect the risks of its business, the resources it has, and the needs of its clients. When setting thresholds, it's important not to go to extremes. Too high, and you may miss suspicious activity; too low, and you may trigger constant false alerts. Flexibility is key because risks evolve over time and new typologies continue to emerge. Step 3 is the implementation phase, and this is where people really matter. Staff who process and monitor transactions must be skilled, trained, and able to handle their responsibilities, whether they are on the front line or in senior management. Effective monitoring isn't just about following procedures. It requires sound professional judgment, critical thinking, and a healthy dose of skepticism. Both pre-transaction and post-transaction checks are important. Pre-transaction checks give staff the chance to question the purpose of a transaction, investigate unusual details, and escalate approvals when risks are identified. Post-transaction checks allow firms to look back and spot unusual patterns that may not have been clear at the time. Step 4 is all about documentation and reporting. Everything collected must be accurate, complete, relevant, and kept up to date. If suspicious activity is detected, firms must follow the proper reporting procedures. It's important to avoid negligence in your assessment. If explanations are unclear or don't make sense, professionals should probe further. A transaction should only go ahead if it passes the test of legality, reasonableness, and commercial purpose. And finally, professionals should never hesitate to seek guidance, whether from experienced colleagues or directly from ICPAC. This ensures monitoring stays effective, compliant, and responsive to changing risks. Transaction monitoring applies equally to all entities supervised by ICPAC, whether accountants, auditors, or administrative service providers. When carrying out monitoring, members should ask themselves some key questions. What is the type and nature of this transaction? Do I have the right supporting documents to justify it? Does it make sense for the client's profile? Could it pose higher risks of money laundering or terrorist financing? And finally, is there a clear commercial or lawful purpose? This list is indicative, not exhaustive. It's a starting point to help members apply professional judgment and ask more questions whenever something doesn't seem right. When it comes to charities, foundations, and other non-profit organizations, ICPAC members need to apply an extra layer of vigilance. That means carefully monitoring all transactions and reviewing supporting documents. Key items include registration papers to confirm legal status and audited financial statements to check for transparency. It's also important to understand the organization's purpose and to identify both its donors and beneficiaries. While most charities and non-profits operate legitimately, a small minority can be misused to hide illegal activity, and in some cases, to fund terrorism. That is why enhanced scrutiny in this sector is essential. Let's now move into a new chapter, where we compare the responsibilities of auditors and administrative service providers. We'll start with auditors. Under ISA 250 revised, auditors must consider whether an entity complies with relevant laws and regulations, including AML, terrorist financing, and sanctions. Their role is to obtain enough evidence for laws that directly affect material disclosures in the financial statements and to evaluate how any non-compliance could impact their audit opinion. To do this, auditors review board minutes, hold discussions with management or legal advisors, and perform substantive testing of transactions and balances. Auditors must stay alert to potential signs of non-compliance. ISA 250 gives examples such as excessive commissions, unusual cash payments, offshore dealings, or negative findings in regulatory reports or the media. Auditors are required to remain professionally skeptical throughout their work, not only during sample testing. If they identify or even suspect non-compliance, they need to consider whether it must be reported to external authorities, in line with law or ethical standards. Although audits are sample-based, auditors cannot ignore red flags. Any irregularities must be examined and, if needed, escalated. This highlights the difference between an auditor's retrospective, sample-based role and the real-time responsibilities of administrative service providers. Administrative service providers are subject to the same rules as auditors, but their role is very different. Auditors review transactions after the fact, while administrative service providers are directly involved in transactions as they happen. This real-time involvement makes their role riskier. They must identify unusual activity on the spot and often under tight time pressure. To manage this responsibility effectively, administrative service providers should maintain robust internal controls, possess up-to-date technical expertise in high-risk areas, and continuously refresh their understanding of the client's operations. Strong professional judgment is equally critical, since administrative service providers are frequently required to make urgent, high-stakes decisions under pressure. Accountants play a critical role in transaction monitoring. They record daily financial transactions such as sales, purchases, payments, and receipts. They maintain general ledgers, reconcile bank statements, prepare balance sheets, income statements, and cash flow statements, and they also calculate and file tax returns. In short, accountants are the ones who record the flow of money in and out. This unique position allows them to identify transactions that fall outside a client's expected transaction profile. That makes them the first line of defense against illicit activities being carried out through their clients. For accountants to fulfill this role effectively, training is essential. They must be adequately prepared to recognize unusual transactions. Training, however, is not enough on its own. The tone at the top also matters. Firms must emphasize why transaction monitoring is important and ensure their accounting teams are educated, well-trained, and attentive to detail. Accountants should regularly update their understanding of each client's profile, and they must act with integrity, professional skepticism, and critical thinking. The transaction review process is a key safeguard for firms. Depending on their size and resources, firms may add what's known as a 4i review, an extra layer of oversight beyond the engagement team. In smaller firms, this may be carried out by the compliance officer. In larger firms, it might be handled by an independent team of experts. This process helps manage risks tied to suspicious or unusual transactions. Examples that should trigger review include unusually large or abnormal activity, complex or cross-border deals, transactions with unclear or high-risk counterparties, or transactions that lack a clear commercial purpose. Overall, the 4i review adds extra protection against compliance, regulatory, and reputational risks. Spot checks and cold reviews are another important part of ongoing monitoring. They serve two purposes: first, to test how effective transaction review procedures are, and second, to make sure they are applied consistently across the firm. Spot checks should be risk-based, focusing on high-risk clients, high-value or repeated transactions, and dealings with high-risk jurisdictions. Cold reviews are performed at set intervals. Smaller-scale checks might be done quarterly, while larger, more detailed reviews are typically done annually. These reviews can be handled by a compliance team or through cross-reviews between engagement teams. What matters most is that they are systematic, documented, and lead to quick corrective action. Proper documentation is essential. All monitoring work must be recorded in enough detail to show how conclusions were reached. This way, a regulator or MOCAs could independently reach the same outcome. Records should include working notes, searches carried out, queries raised, answers received, and all supporting documents. Maintaining these records serves three purposes. It provides legal defense for members. It supplies evidence for investigations. And it demonstrates compliance to regulators. By law, records must be kept for 5 years after the business relationship ends or the transaction is completed. This period can be extended by another 5 years if there's an ongoing investigation or suspicion of money laundering or terrorist financing. This ensures transparency, accountability, and protection for both the firm and its professionals. In this session, we have explored the key elements of transaction monitoring, from legal requirements and the ICPAC directive, to the practical steps firms can take, and the differences between auditors and administrative service providers. Remember, transaction monitoring is not just a regulatory obligation. It is one of the strongest defenses against financial crime. For further details on transaction monitoring, please refer to guidance to ICPAC members on transaction monitoring performed as part of their anti-money laundering, counter-terrorist financing and sanctions compliance checks, available under the Monitoring and Compliance tab in the Compliance Guides section. Thank you for following this educational series on client due diligence. I hope you found this useful. For any queries, you can contact us at compliance@icpac.org.cy. Thank you, and goodbye.